Good evening, ladies, gentlemen. Dare I even turn on, the screen that shows you the stock market? I mean, this was probably another one of those abysmal weeks where people are freaking out. Baby, it's more like Halloween than any seasonal time of year, especially when the market represents it. But I really want to get into why now is more than probably the most opportune time in your history to be a dividend investor. I know I'm not like the end all be all proponent to dividends, and we'll talk about that more toward the end of this stream, but I cannot help but look at dividend stocks and just be like, never in the last 8 years of my investing career have we ever seen something like this to the extent that we're seeing it right now. So what I want to do with you is just kind of walk you through some of the stocks that I find interesting, the community finds super interesting, and then we're going to take a look at what is causing the cause and effect manners behind like the market, how far down the market could go, what the actual fundamental values are that will continue to compound into the future. And it should be a very intriguing video leading into the Halloween best 5 stocks for the next 5 years, baby. So we're going to talk about stocks because, again, I don't think 5 stocks, I couldn't basket just these dividend stocks, but this is where the primary focus has got to be. And I've been looking at a lot of stocks that investors on YouTube have been buying right now, especially things like Realty Income. Realty Income is probably one of the most resilient US REITs that could possibly exist. Probably one of the best REITs globally, not only from a performance standpoint, but from a stability standpoint, considering their debt to asset ratio is absolutely astounding. 49 billion in assets, about 20 billion in liabilities. I don't think the debt markets are going to affect them as greatly. Obviously, there's going to be hindrances and aspects of their portfolio, but being triple net lease based real estate, which basically means they don't manage the properties, they just own the property. The tenant has to maintain and keep it up. It's been a very interesting structure for them, and management's done a fabulous job reinvesting dividends, because as we can see, one of the biggest issues with most companies is the dividend shares issued. And REITs are really famous for doing this, and typically it leads to underperformance, but they've been reinvesting the money they've been pulling out of the shareholders pretty resiliently to increase dividends and continue to add shareholder value. But this could be something that's a lot more challenging depending on what they do with that capital, because we know they're starting to invest into things like Wynn Resorts. I think it was Wynn, wasn't it? They're getting into gambling, a few other aspects of the market to continue to diversify their portfolio. But very intriguing, right? Because when you take a look at their dividends, basically through their entire history, the last time the dividend got over 6%, you pretty much would have had to go back to the 2008 financial crisis. And pretty much historically before then, it used to have around 6%, probably when it was a less mature company. Even though it's been around for a long time, I think back then the yields were pretty good on this guy. So this is something that we've never seen on something like Realty in the past 15 or 20 years. You look at something like Bank of Nova Scotia, the Canadian banks have been beating these like a dead horse, right? This one's yielding 7.65% and has wiped out basically its entirety of the last, I don't know, what is that, 15 years? All the way back. I mean, you could have bought the stock for the same price during 2007 before the financial crisis. You know what insane that is? And then you take a look at, you take a look at the dividend yield, and it's priced as though something like the pandemic is happening. I mean, the yields have not been, so this just shows you that the market is in pure panic. This is what that should represent, right? If the stock price crashed, the yield explodes, yet, the fundamentals aren't completely deteriorating, which that's something that we're going to have to talk about because it is one of the defining factors to why these stocks are acting the way they're acting. It's just, these are quality companies, right? Like insane quality. And we're going to look at even more insane quality in a sec. But I also want to point out a company like British American Tobacco. I've been following this one a lot. I'm not really buying it here. I might at some point. It's something that we've been talking about with my parents in their retirement. Like all the tobacco stocks, this thing is probably the dead cheapest stock I've ever seen in my entire life. It has a dividend that it can absolutely afford at almost 10%, which is going to give you market rate. That's the average. I think that's right. The S&P is what, 9.8, 9.5 or something over the last 20 or 30 years, like the historical averages. But I mean, you're literally getting the S&P 500 returns just in the dividend. And that's presuming they don't cut it, which again, they don't need to cut it. This is a company that is increasing, like they're a leader in vapes and so many of the nicotine products globally with a payout ratio of 44%. You know how crazy that is? And then you take a look at the dividend. Historically, it's never paid out a yield this high ever in its entire history. Look at the telecom giants. Dare I even mention telecom? This is where a lot of my interest is as well, and I'll explain to you why. But telecom giants like TELUS right now are yielding yields they've never seen basically in their whole history. These are historical yields. You look at things like Bell, 7.6% dividend. And again, same sort of deal. Never in Bell's history has it been paying out a dividend like this. You look at Verizon. Verizon arguably, I think, has a more stable, revenue and EPS than the likes of TELUS and Bell do. And its dividend, again, is historically higher than it's ever been through its entire history outside of some, special events like 2008, which are just kind of spikes on the charts there. You look at things like Hershey. You want to talk about quality here. Hershey is now down what? I mean, it's Halloween. This is the time for Hershey to shine. Stock's down 33.38%. It still can't find a bottom. Seems to be constantly finding a new 52-week low here. That dividend yield approaches 3%. Very attractive. You look at something like Nestle. Nestle's already yielding 3.3%, and it's also been in this downtrend, and it's down over 20%, right? I mean, these are AAA quality rated companies, and people have given up on the stock market. That is what this is telling me. All these stock prices, all these dividend yields, the only thing that you could really believe is happening is people have given up on stock. So what are people paying attention to? Let's wind the clock back here and just talk about base fundamentals that arguably do not impact, the values of all these stocks we just looked at, but they are variable when you kind of zoom out and look at the broader picture. And there's one thing we can talk about is the S&P 500. It's the easiest thing to do some of these comparable metrics with. And what we're looking at here is the 5-year earnings of the S&P 500. And this is a microcosm. Keep that in mind. Even though these are like the most resilient companies in the US, it is important to note that the market we sit in is largely hindering different aspects of the market that aren't all inflicted in the S&P 500. A lot of that could be venture capital, hard to raise money in this higher interest rate environment. There's just a lot of other companies that will not exist on the S&P that are feeling this recession a lot harder. But when we look at the earnings that the S&P is currently driving, we are not back to an all-time high basis. And this is only part of Q2, baby. Q3, if you've been catching earnings, stocks have been crashing, but this is probably the best damn earnings I've ever seen since the crash began. And we started seeing a deterioration in the markets coming into the first kind of, interest rate cycle. And we saw the market directly reflect this. So at the end of the day, on the broad scale of things, if you look at this chart that represents all these earnings and look at the pandemic is a good microcosm factor here as well we're going to pay attention to. But you compare it to the S&P over the last 5 years, and it looks comparable, right? So clearly the market follows earnings to some extent. Like that seems to be what's going on here. Very similar chart, 2020 crash. The markets came down here. We're starting to rebound on the earnings that are revitalizing, especially in the Magnificent Seven. A lot of that has been driving this earnings. And now we're kind of getting back into a period where I'm surprised the markets are going down, especially after the earnings that we saw, most of them pretty resilient. So in the macro aspect of things, the market could become irrational against earnings, but earnings are eventually what changes the future rationality of how people think where the market's going. So you get these kind of like micro events where the market will sputter, but over the long term, it should realistically, again, in the broad view of things, follow that earnings per share metric, right? So what's another thing that drives value? Because clearly the markets have gone up higher than, the earnings have been at a higher pace. What causes that? Well, it has to do with money printing as well, right? So basically, if you print more dollars, there's more dollars chasing more assets. Deflation, right? That's what happens. And what happened during the pandemic? Well, the markets tanked. Everybody was at home. People freaked out. Once in a lifetime craziness going on here, or at least once in a decade when these crashes tend to happen. And sure enough, the Fed's like, we can fix this with money. So they printed a crap ton of helicopter money, which you can see in this little gray line here representing the mass amount of money printing that would soon follow. And this is why it's highly unlikely we're going to see a substantial crash to any severe degree, in my opinion, because typically when you see these huge periods of money printing, it's hard to see a crash because all this money is just floating around, deflating everything around us, right? Or this is what causes these inflationary pressures, not deflationary, but inflationary pressures, because there's just more dollars chasing more assets. And the craziest thing about what's going on here, not only are you seeing more dollars chasing, more assets, which again raises the value of homes, which raises the value of stocks and Pokemon cards and NFTs and everything that just went crazy bananas in this period of money printing. Not only did you see all that insanity going on, but what we also saw was a huge spike in demand for US dollars. And I think this has to do with geopolitical events, because I don't know how in a time where you're printing more money than the US has ever printed, but you're seeing the most demand for US dollars than pretty much has ever been seen. Like even during coming through the dot-com bubble, because there was so much resiliency, I think, in some other countries and what was going on globally, and China was coming up obviously with shipping and everybody was trying to start exporting, their goods out of China. I mean, I just think there was more global demand back then for foreign currency. And then obviously we saw a bit of a decline, but now we're back to 20 years high. People are so damn confident in the US dollar during one of the worst periods in US history. The dollar's at a 20-year high. So it's like, this is why it's such a weird, this is a recession. What we are experiencing right now to some varying extent is a crash. There's just a very small, minute amount of companies that are kind of making it look a lot less worse than it is. But if you could have put micro caps into an ETF, and you put a microscope on that, it would be devastating. It'd be a full-blown crash. I mean, you put it on like the auto market, which is looking to be pretty abysmal at this point. We're seeing, I think there's a crap ton of delinquencies and repos going on in the auto market. Like, there's certain aspects of this market that are just getting destroyed. But it's crazy on the big scale of everything combined, what kind of demand there is in the U.S. market. So this is why I'm not worried at all about this crash that people are freaking out about. People think real estate's going to come colliding down and all this stuff. We might see a correction. We could go into a bit of a deflationary market because interest rates are going to be a cause and effect to these kind of pressures. But there's so much going against these headwinds that it's hard for the market to just come calamiting down when everybody's employed. There's still more jobs than there are people pretty much out there. And the interest rates are the only thing really fighting it. And what people don't understand is this is going to be temporary, but this is one of the primary causes right now that is calamitizing so many of these dividend stocks that we're looking at. And I want to break down exactly why interest rates are causing a lot of the destruction we're seeing, why it's going to be temporary, and why, again, this is the time to primarily be a dividend investor. And again, I'm going to kind of give you my broad view opinion on it. I just really wanted to kind of speak on the dividend side because I know it's a big topic and people love their dividends. And I'm telling you, if you're heading into retirement, I'm telling you, if you're looking for a good rate of return, forget bonds, forget high interest savings accounts, forget guaranteed investment certificates. Just look at dividend stocks because you're missing out on potentially one of the greatest buying opportunities of 10 or 20 year time frames. It's absolutely ridiculous, right? So before we talk about these stocks and some of these defining factors, I think it's really intriguing again to look at the broad perspective of earnings, because for all the earnings we've seen thus far, which a lot of these dividend stocks, some of them have reported, Coca-Cola, Pepsi, really good numbers, Procter & Gamble, we're starting to get into the Canadian side of the border here very soon. At the end of this month, we'll start seeing some of the banks in November, and we got Shopify coming up here, a lot of these big tech companies. McDonald's is on Monday, HSBC, which is a big Canadian counterparty bank as well. And if these earnings continue to persist to be much more stable and continuing to evolve into a better place, because these companies have had the last quarter or last 2 or 3 quarters to start firing people, controlling their balance sheet, fixing margins, all that is starting to come into play, right? So they're just trying to fight the interest rate battle, some of the debt payments, and deal with those softening in demand because they're not printing money like they were during the pandemic. And they're trying to pull that money back out of the market to some extent. But these companies are proving to be resilient beyond anybody's measure of a doubt. Like, you cannot tell me that this earnings period, from what we've seen so far, has not been one of the greatest earnings in most of these stocks' histories. Google, record numbers, man. Amazon, crushing it. Like, how can you not look at those numbers and be amazed in what a crappy market we're in and not presume we're heading for a soft landing? So if you believe, like I do, that, yeah, there's going to be some mixed calamities, but on the broad scale, it's just not that bad. And we're going to ride through this, and we're on the cusp of coming out of the eye of the storm. It's only now that the opportunity starts to exist where you can start predicting the next 6 to 12 months. Now, obviously, nobody knows when they're going to cut rates, but I am promising you it's an inevitability. They're going to cut rates. I just can't get over people will not believe they're not going to cut rates. So I don't know if people are just hiding out. We know for a fact people are hiding out in money market funds. So this is like my prediction, right? I believe there is so much money sitting in high interest savings, money market funds, and GICs that people would rather get a guaranteed 6% than deal with the current fear in the market. I think the fear is starting to become vastly overblown because it's part of a temporary fix to something the Federal Reserve did and the Canadian banks did during the 2020 pandemic. And now that that's starting to kind of come to a resolve, they're going to miss these crazy discounted opportunities when they start cutting rates, and all of a sudden money market funds, GICs, savings accounts are not going to be yielding 6% anymore. Where is that money going to go? It's going to go to where the rate of return is going to be, and that is going to be in assets, whether it's going to be real estate, whether it's going to be stocks, and they're going to want that yield, and they're not going to get it from high interest anymore. So there's going to be more money than we've ever seen sitting on the sidelines start coming back to this direction. That is my prediction to the next bull run, right? So if we take a look at some stocks, what's going to happen, and these are the stocks that I call highly recognizable for a rate of return, because these are the stocks being directly impacted by this short-term Band-Aid. But the thing is when you zoom out and you look at the company's total of how they've been doing, it's kind of mind-boggling that these things are trading at the levels they're trading at. Either that or tell me if I don't know what I'm talking about. Please, if this does not make sense to you, and maybe there's some money manager doing like $1 billion trades out there, to get him and ask him, am I wrong? I mean, you look at something like Telus, for example. These are infrastructure, highly debit-based companies that are largely inflicted by the interest rate cycle. It is down 36% with a current 6.6% dividend yield. Now, these companies have a chance. Yes, they can afford, I believe they can afford the dividends today. That doesn't mean they're not going to cut them. There's always room for dividend cuts to do share buybacks or make the company more resilient. But because these are pronounced dividend stocks, I highly doubt they're going to cut them. Now, Telus is a company who has been hitting record revenues and has been scaling the business through one of the worst market environments we've seen in quite some time. This has to do with immigration. There's so many macro effects into play here that has to do with Canada's economy. You might not be a Canadian-focused investor, but I am. So you look at this, right? And you're like, holy crap. I mean, we're talking about revenues. And again, companies don't always trade off revenues because we're seeing that right now. What they're trading off of with a company like this is their EPS. This company has been putting record levels of cash into their interest payments because of the infrastructure they've caused. They've been doing depreciation of new infrastructure they built, and it's just been beating up their bottom line. And the stock seems to be directly following this bottom line, right? So this is going to come to a bottoming very soon, because interest rates are about to be finished going up. So this is going to start leveling off, which means it's likely the stock price will as well start leveling off. And then comes the next part of the cycle, right? They're going to start cutting rates. And then as quarters go, every time they keep cutting rates, we're going to start seeing that come back to the bottom line. And then these are going to start going back up because the company has record revenue. Eventually that revenue is going to hit the bottom line as soon as they stop putting it against friggin' crazy debt payments. And then all of a sudden, if the company survived this horrible market environment, which I think it is surviving, it's going to come out on the other side of this. The stock price is going to recover. Am I wrong? Am I not seeing something here, right? Because there's so many stock prices that resemble this. And I think, again, you're going to get beyond a compound of just the stock appreciation and EPS and, perception changing. You just have a record level of cash that needs to go somewhere. And it's going to find stocks like this, the ones that are especially recovering, right? So we'll read through a few comments, and then I want to get into, obviously, some of the other factors at play here. Some of you have left some really good comments on some videos. Keep in mind, when the BOC Fed cuts rates, it's generally to stimulate the economy during bad times. I would 100% agree, but we know, unlike bad times, because usually bad times come out of nowhere, they're only going to cut rates because they're using it as a tool to calm inflation. This isn't like something that just happens, right? I mean, inflation wasn't out of control during the last decade. I mean, think about it. The last decade, interest rates were damn near zero and inflation was nominal. It's only because they printed money. And they know as soon as they're done printing money, they want to re-stimulate the economy because the Fed is greedy. Unfortunately, the Bank of Canada is greedy. The entire capitalistic society works off greed. How do we propel greed? Well, we need growth. We need, wicked growth in our small caps and our family business and this and that. How do we get that? By stimulating the economy and cutting rates. We just can't do that today because inflation isn't in check yet. I promise you, as soon as inflation is in check, as soon as we get a little bit of a hint of, sniffing out those rate cuts, watch what happens to the market. They're going to repronounce, like, the whole projections of everything is going to change. Who's holding cash? I'm broke. Well, you just cost average, man. Keep working. Don't hold too much cash. Obviously, I have an emergency fund, but beyond my emergency fund, I don't want to hold cash in a market like this. Obviously, keep some protection, but don't go too crazy. I'm 66% cash right now. My guy, so look. This is kind of what we're doing in kind of perspective with my parents heading into retirement. If I had a lot of cash, this is what I would do. Don't go all in at once, okay? Keep your emergency fund set aside. Do what you got to do, but I would be spanning out the next, I'd say, 5 to 6 months, maybe at 1 or 2 quarters, and I would take the vast majority of your cash and I would buy every single month as aggressively as you can within reason to kind of spread that cash out over the next 6 months. Because I think the next 2 quarters are the buying opportunity. I'm 80% cash. You guys are my exact example of why the market's going to rebound. You're literally giving me my example right here. So many people are in cash. It's like, you guys are being like, and again, I'm not being crude here because, like I said, I've got good cash I'm not buying as crazy as I should be right now because I'm obviously waiting to the beginning of the year to tax my TFSAs. But I mean, as soon as the market starts to rebound and everybody's fear alleviates, you're not going to want to sit on cash. As soon as the market flips, you're going to be like, forget this cash. I want to be back in the markets, right? So you're going to go aggressive into the markets. It's just people are scared right now. And people, fear compound to be greedy when people are fearful. That is the hardest thing to remind yourself. But I'm promising you, this is a window of opportunity that is not going to be here for very long. That's the thing happening right now. More dollars are chasing, fewer assets. That comes back to that conversation. Is like, obviously the more dollars they print, there's fewer assets chasing those dollars. So you get inflation. But in a moment like this, we're seeing like all this money out in the world, everybody's just hoarding cash and it's not chasing these assets, but eventually it's going to be, and you're going to get into a bull market. Unlike, you could see pops in the market by like, I wouldn't be surprised seeing like a 5 or 10% pop. We're going to get days in the market where you're going to see some extreme movements to the upside. I don't know when it is. I don't know how low we go. I'm not telling you when or how to buy. I'm just saying, like, I don't think I've been more bullish now than I've been in a while. So let's get into some of the comments, because a lot of you do point out that, like, what do you think about XEI and VDY too? I think they're great opportunities with all the banks selling off and the yields are very nice. So yeah, so when it comes to VDY, this is honestly like my easiest way of buying into the market, because as much as I love all these individual stocks, it's better to just pick up, like what I prefer to like to do is obviously VDY, awesome. SCHD is great right now. This one's been hindered. You get a lot less volatility from the market, much more stabilized dividends. A lot of these pay monthly, and it gives you these wonderful stocks. I mean, these are the basket of the greatest dividend stocks you could pretty much own on an individual basis. So what I would recommend doing, and what I like to do, is just focus on buying these ETFs regularly, and then pick a couple of the stocks that don't get represented in these ETFs. So like BTI, I'm kind of killing myself because I almost want to buy BTI, but those are Realty isn't really represented in these funds. So you could buy some of those stocks separately and just kind of parity them to these funds. A lot of people are saying, like, if the S&P 500 returns about 10% a year over time, would it be better to sell 4% or more per year for income off an S&P 500 ETF at retirement, and then and still letting your S&P 500 ETF grow instead of buying SCHD? So here's like one of my ultimate concerns with the market, and why, like, as my portfolio scaled and as a skittishness and intelligence is built into my brain over time, the problem is like, you can't always guarantee, because we don't know if another black swan event comes. And obviously my predictions in the market are highly, speculated on, that things are going to be smooth. That doesn't mean that, a global war doesn't start to happen. I mean, there's a lot of things that could come into play. So the problem is, if something catastrophic happens, we could truly see a decade of no gains in the S&P 500, like we saw, during the dot-com bubble, let's say. So if we take a look at the S&P 500, I mean, you don't want to end up in a market where we don't get any growth at all, right? So, I mean, you got to imagine that and I don't think we're in that kind of market. I honestly think we're still heading back toward a growth market. But you got to imagine, we've already seen, like 3 years almost of, or a good year and a half. We're going on 2 years of absolutely no capital gain return out of the S&P 500, right? But if you go back to the dot-com bubble, we didn't see any returns for pretty much, it was well over a decade, 13, 14 years. That's a long time to own the S&P 500, especially if you're in retirement, not getting that average rate of return of 10%. Again, historically, over a 20-year period, the S&P 500 has never lost money. But the problem is if you're in retirement, you can't pull 4% out a year, especially if you're not getting any growth out of it, because then you're losing the return. So that's why I think it's kind of like the Dave Ramsey approach, where you do want to focus on a broader spectrum of companies. And that way you're getting cash flow, like Dave Ramsey says, get growth and income, broad market ETF, whatever, your global market ETFs. I don't like going as crazy as Dave Ramsey does, but I do like fixating on growth and income. Those two are like my favorite baskets, because when the market grows, you're going to want to own those growth stocks. And when the market's not growing, you're going to want to own those dividend stocks, and you can balance your portfolio so you never have to sell the stocks. Because ideally, when I get to retirement, I don't want to sell the S&P, but as I told my parents, it's not all about dividends. It's a good time to cost average into the S&P, because on those years when the S&P does very well, hey, take a percentage out of it and use it for a trip, use it to buy something nice, do something good for yourself, right? So even in retirement, you can still balance both these kind of, investment theses. And it's what I'd prefer most people do, just to protect themselves and kind of get the best rate of return out of the market, right? And again, this is a great time to have dividends, because you can buy the S&P with the dividends. You can take SCHD. I'm reinvesting my dividends in SCHD. It's quicker compounding my dividend growth. I mean, there's a lot of opportunity to both sides of this. So SCHD has turned into quite the nightmare in this, environment. You should be more excited during a crash than a rally. Where noobs see a crash, I see deep discounts. So you can kind of see with these comments that are, going on my videos that people are obviously very polarized about investing because these are truly the greatest assets you can own. The SCHD holds some of the greatest dividend stocks that any dividend investor would want to own. So, I mean, this just shows you that people are more scared about the current market environment. And you in our comment section are proving a lot of that by how much cash you have on hand, right? So, again, I just see that as a presented opportunity. So here's another really fun comment we can finish up on. Are you sure, he says, are you sure we should be buying with recession on the horizon? So this is what most people are thinking. What's happening with the stock market looks more like what happened around March of 2020, after which stocks recovered strongly. I'm buying. And then he replies, not really. Rates were near zero at that point, and now we are way higher. Markets usually crash the hardest when the Fed is cutting from a hiking cycle. And I agree. Typically, the Fed, as you mentioned, one of you guys commented on this video already, typically they'll start cutting rates when the market's falling apart. That's what they'll tend to do, but we're not in that kind of market environment. Right now, it's just a cycle where they're going to inevitably cut rates. I don't think they're going to cut rates because the economy is crap. They'll cut rates because inflation is under control. Whereas before, and historically, when a recession hits, they'll cut rates to stimulate the economy. But those crashes aren't really good examples of what's going on today. History doesn't repeat, but it does rhyme, right? So this is why you dollar cost average. No one can predict what the markets or the economy will actually do. If you're waiting around for a recession to buy low, you're just trying to time the market, which never beats timing or time in the market. And this is very true because historically markets bottom before the recession is announced. So that's another funny kind of counterintuitive thought, that the market already starts recovering before we can actually conclude that we saw a recession. So yes, interest rates are higher because the government is trying to curb inflation. Stocks, however, have plunged quite a bit, much like they did in March of 2020, not as aggressively, obviously, but 2022 was the worst, or 2022 crash was worse than 2020. Do people really expect 3 cataclysmic crashes in 3 years? You never know. You never know, folks. But I think it's always important to just take a step back and take a breath. And at the end of the day, I always recommend just keep buying. Don't stack cash in a time. Again, you can keep cash, do whatever makes you comfortable, but don't stop buying. Hey, my comments. Yeah, man, I'm relating to you. I've been having a lot of fun reading through all these comments of people and just seeing and I wouldn't mind getting your thoughts while you're in here too, man. Are you buying stocks? Is these recession fears holding you off? Because my bull thesis is that there's too much fear in the market and it's starting to get over dramatized. These dividend stocks have unbelievable yields where you can get market rates of return out of them if you pick the right dividend stocks and you wait for the recovery. Not only are you going to get great capital gains, but you're going to see, some crazy dividend returns. So what are you saying? I'm still on the side, scared to jump in. I really hope you guys are cost averaging and not being that scared. I mean, I've just never looked at a market like this, and I'm kind of getting bothered that I'm not buying more aggressively. I'm going to have to sit down with the wife and have a serious conversation this week because the October always seems to be the bottom. I'm buying Qualcomm. But anyways, man, what a conversation to be had. I really hope you guys are enjoying your freaky Halloween weekend here. I've been doing a lot, trying to enjoy the holiday. It's one of my favorite. What do you think of TNT at a 20% yield? TNT is is TNT the stock? I think it is. What are you talking about? So this is a REIT, right? And I don't know, did they not cut the dividend yet? I'm pretty sure they cut the dividend, unless it's already, because you're talking about True North Commercial REIT, if I'm not mistaken, right? Is this the TNT you're talking about? Should trade on the TSX, right? Unless it got downgraded. I could be wrong, but these REITs have been getting absolutely clobbered, right? I can't even pull it up right now. I think it got delisted to OTC. I'm not sure what talk you're talking about. I'm buying Tesla. Good for you, man. Bit crazy. Tesla, I'd love to see below $200, but people are going to hate on it. I promise you right now, I think Tesla and so many stocks like Tesla are about to get devastated. I could be wrong. I mean, the hype could be in there. I'm a long-term believer in Tesla stock, but I'm looking at the negativity and it's starting to overtake the positivity. And unfortunately, there are, primarily getting their sales from cars right now, and those cars are not selling like they want them to be. So the microcosm event is going to open up another window of opportunity for Tesla stock, which I will also be a proud buyer. But if I had to pick tech stocks right now, I'd be buying Google over probably Meta. I'd be buying Google I think Google is probably the cheapest S&P top 10, and I think it has the highest potential of all of them right now. I mean, I was just hanging out with my brother's kids and, I was taking them out and we were having fun and they want to be YouTubers. These kids are like 7 and 8 years old and they want to be YouTubers. And you look at the fan base of like Mr. Beast, the guy's a billionaire. You don't see billionaire brands growing off Netflix right now. You're not seeing Disney. I mean, did you watch South Park? Oh my God, did South Park ever rip into Disney stock? I couldn't believe it. I'm not a big South Park fan, but that episode was absolutely, balls to the wall, man. They just took it far too north. So yeah, you're talking about, TNT cut their dividend already. True North Commercial is getting wrecked. Be really careful with REITs. Somebody already pointed out something like Canadian apartment properties. You got to be really, really careful with REITs here. I think REITs could come out of this and have a full recovery, and not a full recovery. But the problem with it's very, I have a hard time with REITs. I'm sorry. They scare the crap out of me. I really only like things that I know I have like direct like understanding of, which is like, and again, who really knows what kind of understanding you have? But again, you look at Realty Income, Canadian apartment properties, I think is pretty resilient here. There's a few REITs that I'd look at, but I'd be very careful about REITs right now. They scare the crap out of me. Starter position. Yeah, for sure. Anyways, folks, I hope you guys are having a wonderful Halloween. You're not freaking out too bad. I'm just kind of coming here to calm your nerves, tell you to take a breath, and remind yourself that you are the reason that the market is going down. Everybody's freaking out beyond belief. And I think I just got to, be a testament to my word, and I have to start buying. Forget waiting for my tax-free savings account to open up because I've got 160 or $80,000 of contribution room. I'm sitting on a good $15,000 of cash. And I think I should just kind of bite my tongue and spend the next 2 months and start cost averaging. And at the end of this year, just sell it and trade it over no matter where the market is. If it's down, I'll take a bit of a loss, write it off. If it's up, I take a bit of profit. Doesn't matter. I should just be buying. I mean, because I don't know. I just feel like the window of opportunity should persist for as long as rates are staying up and there's no sniff out of a cut. Because I think we got a good 6 months, a good 6 months. So we could go lower, but I think we're going to start seeing bottoms in these stocks, and I'm hoping it persists. And take advantage, folks, because you're going to get rich in a market environment like this. Stay cool, stay awesome, and as always, I'll catch you in the next one. Peace, folks.